Hello everyone, welcome to another episode of Market Bites. Hope you are all doing well at home. Like, share, subscribe. It's all appreciated. Today we have 2 out of the 3. Unfortunately, Josh is feeling a little bit under the weather today. So Joshua, if you're listening to this, I hope you feel better soon. You're going to be sorely missed as usual. But Neža and myself will hopefully steer the ship. Neža, how are you?
I'm doing well, thank you, Sam. And I hope Josh will feel better soon. He had a busy week in Abu Dhabi, so it makes sense that he got a bit under the weather.
Yeah, it does. It does. All that traveling, it does take it out of you, doesn't it? I mean, I had a period
Yeah.
recently where obviously we were in Paris together, and then I had a stag do in Newcastle, which was quite a heavy one. Then was off to Dubai, and then had weddings. And honestly, by the end of all of that period, I was just like, I now need a holiday just to do nothing. But no rest for the wicked. And the markets don't rest either, do they? I mean, it's been another interesting time. So today, I mean, the title of the podcast will give it away. We wanted to talk about the Moody's downgrade, and this year, Neža, it's been interesting, hasn't it? How literally, if you don't pay any interest to what goes on a Saturday and Sunday on the markets because it's the weekend, you take time off. By Monday morning, there's a new headline. You know, we've had it
Yeah.
with deep sea, we've had it with all these other things, and this time it will happen on Friday evening after the market closed. But we had another headline that moved markets. So Moody's, which is a rating agency, downgraded the US credit rating from AAA to a small A1, and it triggered a bit of a market reaction. It's always prudent, I guess, just before anyone starts trading on a Monday or investing on a Monday, just to be aware what did happen over the weekend. This year has proved that more than anything. But how big a deal do you think it is that the US has lost its remaining AAA rating?
You know, as you said, this year, all important news come out after the market closes, and especially after market closes on Friday. And of course, this time was no different. But if we talk on how important it is that the US lost their last remaining AAA rating, on paper, Moody's downgrading from AAA, which is the highest rating, to AA1 doesn't seem like a huge deal because, like, it's just a notch down. It's not such a big deal, right? But the US ratings is still remaining extremely high. But the truth is, under the surface, this is a pretty big moment, and we saw that on market reaction. Because here is the thing, Moody's was the last major credit rating agency that was still holding on and saying, yes, the US deserves the highest rating possible. And S&P, for example, another rating agency, downgraded back in 2011. Fitch followed in 2023, I think. And now Moody's finally joined the club. And that means that no one basically is giving the US a perfect score anymore. And that says something, I think, because a rating from agencies like Moody's, S&P, and Fitch, it reflects how borrower, like the US government, is likely to repay their debt on time. And with higher rating, it is signaling a lower risk for investors. But still, this AA rating is still very high. But nevertheless, it didn't get riskier overnight because treasuries are still considered the safest asset in the world, basically. But this downgrade is more like a symbolic turning point, I would say. It is just like the way they would be saying, yeah, your debt isn't just there on a long term and theoretical anymore. It is becoming real, something like that. And basically, they pointed out that US debt and interest payments have grown so much over the past decade that now they are above other countries with similar credit ratings. And they are saying, like, you don't do anything meaningful to fix that. And this is a pretty harsh message for Washington. At least I think so.
Yeah, I mean, it's it's always funny, these things, and I'm talking about any headline. You get people on social media, you get people on Bloomberg, Reuters, whatever, that will say one thing that's really like, this is the end of the world. And then you get others that do the
Yeah,
complete opposite. There's very rarely is there something in between where people are generally like, you know what, let's just wait and see what happens. Everyone feels like they've got to have an opinion straight away on a matter where they may not be an expert about it. It's like literally the DeepSeek thing. Within 6 hours, suddenly everyone's an expert on AI language models
of
when you don't
course.
need to be. It's a case of, sometimes just having a bit of patience isn't the worst thing in the world. And what I would get from your tone there, and what we'll talk about in this podcast, is that it's not actually that bad. And the market reaction was kind of similar to that, which we'll discuss in a moment. But it's a headline, and the market moves off headlines.
Yeah, exactly. And it was not that unexpected, actually, because we were expecting it for a while and we saw other two agencies downgrading them before, years
Mm.
before. So it's not something that the market wouldn't expect, but still we saw a massive reaction in the beginning because we saw stocks falling, but then recovering. And then we saw, of course, bonds selling off and they were bought at the end. So we saw this maybe push-pull reaction. And what can we even read from that? Is there anything behind it? Who was even buying the stocks and the
Yeah,
bonds?
well, do you know what? I think it's like whenever there's a data release that comes out that's like significant, and I'm going back to my day trading days, whether it might be a non-farm payroll release or a crude oil inventory release, and if I had no interest in actually trading the release, sometimes I would wait like an hour just to see what the market generally does feel. And the event happened in these scenarios, and then an hour later you sort of, okay, well, okay, it was a hawkish release, or it was really good or bad for oil price. And with this as well, I think having time to step back and then just wait to see how the US opens is a good bit of advice for people. And the fact that you mentioned there everything recovered kind of shows that, okay, a little bit of panic initially, but things aren't actually that bad. It's a bit of a not necessarily non-event, but not one which needs panic. And by the way, retail traders believe that to be the case. And I'm not sure if you saw this, but retail traders on Monday in the first 3 hours of the trading session, bought $4.1 billion worth of US stocks, which is the most in history for a first 3 hour period, which goes to show it's just like, you know what? If you give us a dip, we are buying it. And we go back to what we talked about last week, which was a follow up from what we talked about a few weeks before that, whether retail or institutionals are going to win. And retail are laughing right now. They are. And obviously the music will stop playing at some point. But for now, retail are, they're buying the dip. They believe that things are going to recover. And in this scenario, they believe that to be the case. That buy the dip mentality is strong. It really is. You could also argue that there's resilience in the bond market. If you get a sell off, okay, fine, let's get involved. We're still believing that the US is the biggest safe haven that there is. So if you give them an opportunity to get involved, they're going to. And also, if you look throughout history, you mentioned there about Fitch in 2011 and so on. And yes, there was an initial big reaction, I think, back in 2011. I think it was like 6% move, but it recovered very quickly. And then the next one a few years later, it was a less sized move to the downside and an even quicker recovery. And obviously, now it's just kind of like, right, let's get in. You get into, the market, buy the dip like retail did, and things have recovered. That's not to say things aren't going to still be a little bit of an issue. And there are some things that do need to be sorted. I mean, yields at the levels they are is probably a little bit of a worry too. And people start to talk about that, not just in the US, but also in places like Japan as well, looking at the Japanese bond market. So it's certainly an interesting time, but what it tells us is that the market doesn't really think it's a big issue right now, just purely off on that headline. and retail believe dips are there to be bought, and they're buying them, and the market has recovered instantly. I think people were unsure maybe about whether it could recover straight away in a day, but it did. It's pretty incredible.
I was not expecting that reaction that fast, to be honest. I thought that we won't get everything bought back in few hours as we did. But for now, it seems like retail isn't changing its opinion. They're buying dips, as you said, as we mentioned so many times throughout this podcast in the past year. And for now, it seems like they're using all the dips just to get more money in the US market. And maybe this is for long term. As you said, yeah, the music will stop playing at some point, but of course, no one knows when this is going to happen. And whenever they see a pullback, they take advantage of that. They get more money into the market. And yeah, it seems like it's not such a big deal. The news was huge. It was everywhere on X, everywhere. But it doesn't have that initial effect on the market that it's such a big deal. Maybe we will see consequences over the next following months. Maybe we will see somewhere else in the economy consequences of this event. But for now, it seems like it's not such a big deal.
It does feel like that. But as we said, the yield situation is worth discussing. And sometimes it gets overlooked, certainly by retail. So let's talk a little bit about, I don't know, borrowing rates for consumers, like your mortgage rates or your car loans, and how do they really get affected by Treasury yields?
Yeah, I think it's important to explain that, because when we say, yeah, the 10-year yield is up, it sounds like some just finance headline, but actually there is some effect on actual consumer and their wallets. In short, treasury yields matter a lot, especially 10-year treasury yield, because that's the benchmark that lenders use when they're price out those long-term loans. For example, mortgage rates, they don't follow Federal Reserve rate directly. They track 10-year treasury. So when 10-year treasury spikes, mortgage rates almost always go up as well. And when you hear that 10-year treasury is pushing higher, and especially when events like this happen, it's not just a market noise. It means that your mortgage might get more expensive. Your car loan might come a bit higher with monthly payment, and it might be even harder to finance things like student loans and home renovations. So everything is impacted by those treasury yields. And we are already seeing that on the market, because mortgage rates have been sitting above 7% in many parts of the US right now. And yeah, what this 7% even mean? This is double of what people were locking in just 2 years ago. And when rates are high, fewer people can afford to buy, basically, which means that housing market can slow down in the future. Sellers won't get the prices that they want, and this effect can spread across the whole economy. And same goes for car loans, for example, because higher rates means that there are highly monthly payments, and that means that people can delay their new car purchases. So everything like that slows the demand. It doesn't mean that this is necessarily going to happen, but this is one of the possible events. So yeah, when treasury yields spike, it's a signal that borrowing costs across all board get more expensive. And this is how consumers get directly affected by that. So this stuff matters way beyond the Wall Street.
It matters a lot. It matters a lot. And you know what? I can completely understand why some people in the market are hesitant, to get involved with prices trading at these levels in equity markets based on what's happening in bonds. And look, there's a couple of ways to think about it, because if you're a super long-term investor, if you're a passive investor and you're buying different ETFs, but one of those being, exposure to the S&P 500, for example, the SPY or the VOO, whatever, and you're saying to yourself, I'm going to hold for the next 20, 30 years, I'm going to buy in every month or every quarter, or, lump sum invest every time it drops 10% or whatever, right? Whenever you get your bonus, you pay. ultimately you're not trying to time the market and you're holding it for a long period. So headlines like this, whatever, right? You understand that you're going to lose 5-10% here and there. The average drawdown in the S&P 500 is 12% every year, for example. So you're not really too bothered by that. If on the flip side, you're someone that's looking to time the market better or buy individual stocks for anywhere from sort of a few months to a year, then you've got to be aware of this stuff, and it might be that, okay, you just say to yourself, fine, the market is going higher, but I'm not going to chase it because I do think this is an issue and actually I'm going to look elsewhere. So it's a tricky one for investors, but I guess for those that are super long term, you almost just say, whatever, doesn't really bother me.
Yeah. But it matters when you are investor with lower risk
Yeah,
tolerance, for example, or if you have been investing for 30 years for your retirement and now you're
coming
just
closer.
3 years before your deadline that you want to retire. So if something like this happens, that can affect your investings. And that's why you need to pay attention to events like that, because it matters what is your investing strategy and how it's going to get impacted by events like this. Because if you have 30 years ahead of you, you might be thinking, yeah, I'm going to take advantage of those pullbacks. It doesn't matter what will happen in next 5 to 10 years even. But if you only have 3 years more, for example, you're going to pay a bit more attention to what is happening on the market and what can happen in the next 3 years. But talking about possible scenarios, there are few possible scenarios that could either worsen the US credit rating or help to restore it. But how is any of those even possible in the eyes of investors or credit or rating
Yeah, well,
agencies?
I guess if you're an investor and you are that sort of 2-3 years away, this is important to think about, isn't it? Because these scenarios in theory, listen, in markets anything can happen. I think that's
Yeah.
that's what we've learned over the last few years and certainly the last few months. Certainly on a Friday, Saturday, or a Sunday, when the market is closed. Look, I think the main point here is the US is going to be that number one safe haven. However, if that doesn't happen, it's not just going to be the US that's going to be affected. It's going to be all markets. It's going to be all risk assets. I think one thing to say just on risk assets is Bitcoin has, been so resilient to things lately. I mean, it's just, I think as of last night or this morning, whichever way you want to look at it, it's just had its highest closing price ever. And people aren't really talking about that. It's incredible just how resilient it's been. But that said, if the US were to get downgraded again, risk assets won't do well. They won't do well. That will be like the final sort of domino that falls that brings down the deck of cards, I would say. So yeah, that's something to think about. But then it's then we're in big trouble. I think there's certain things to keep an eye on that could positively make things a little bit better. And if GDP does well, if economic data looks better, these are things that in theory you'd expect to benefit the situation. It would reassure the agencies and investors as well. And if you can get those lower yields on treasuries, that's going to help as well. It's going to ease those borrowing costs that you mentioned about there as well. On the flip side, scenarios that could maybe make things worse is just going to be worse data as well. If you start to see even poorer GDP numbers or rising debt to GDP ratios, and these things aren't going to help, and failure to raise revenues or cut spending, ain't going to help. There was also a tweet. There's always a tweet, isn't there, from Donald Trump or a post on Truth
Yes.
Social, and he immediately said it's backward looking, which in theory the reasons were backward looking, and also it's Biden's fault. So there is an argument to say this was all like a political play, and so that could worsen, or things get a little bit better and there's less uncertainty there, and the debt ceiling comes under control more, and things get better. But that's obviously something to keep an eye on. Recessionary fears as well. I think last time I saw, or this time a week ago, we had a great start to the week, and the recession fears were down, and then you had this headline, and they go up again. There's a little bit of uncertainty, which markets, as we know, don't like. And also I think another thing to focus on is the dollar. That had a reaction to this. If that gets stronger or weaker, things can get impacted because of that as well. But I think ultimately, I'm not too worried right now. I think that the main situation, which was a situation before this downgrade, was the yield situation in the US, and you wouldn't want that to spiral out of control much more than it is now. So that's the focus, I think, over the next sort of few weeks and months. Can that come under control? You've obviously got, more inflation readings before the next Fed meeting. You've got a load of different bits and pieces. You have a jobs report in, I imagine, 2 Fridays' time. Just have a quick look at the calendar. 3 Fridays' time as well. So that will be worth keeping an eye on, the first Friday of the month. So yeah, I don't know. They're currently shrugging off the downgrades, aren't they? But that said, there is sustained fiscal deterioration. That's going to shift sentiment further negatively, and then could lead to further sort of negative sentiment in the market, and risk assets come undone. US, markets aren't then seen as favored as they were before. But I don't know. It doesn't really feel to me like that's around the corner.
Likewise, I think it's not that concerning, but in these times of uncertainty, we see so much uncertainty on the market. In the past few months, all of those news. And I think that the market is just waiting what will come around the corner, what news is going to be next. Is going to be a positive or negative, and it's going to turn based on this news for a few days, and then maybe we will get some relief again on upside, downside, but generally I don't see many of concerns right now, especially regarding this downgrade. I don't think that it's such a big deal for the markets right now. Of course, reaction was expected. We saw it, but I think that now we are moving on and we are already looking forward to the following news and following data that we're going to get from the market. Of course, some positive macroeconomic news would be much appreciated, because if we see that overall economy is still doing well, that it is resilient, like jobs report, that labor market is still doing well, and that inflation is heading where it needs to be heading, and that the Fed comments won't be that hawkish. I think that all of things like that would spark a positive reaction on the market. But of course, we can also see something negative coming up, and no one can predict what will happen, basically. So we will see what we'll talk about in the following episodes, I guess.
I suppose it's on the labour market is still relatively strong, and I guess that's one of the reasons, if not the main reason, that Powell and the FOMC are just like, why are we going to cut rates when things are okay in that regard? And so maybe it's a case of the next leg up for markets, and by the way, there could be any headline, but the next leg up comes if you get a bad labour market report, because then it's like, okay, fine, we are going to start cutting rates again. But who knows? The biggest moves in markets come from the most unexpected reasons and sources, because you can't price that in. So yeah, I'm sure there'll be more of that to discuss. Listen, could well be another headline over the weekend. Who knows? But we'll be here to discuss it all. As always, we'll wrap it there for today. If you enjoyed the episode, like, share, subscribe, give us a rating, all of that. But Neža, as always, thank you very much.
Thank you, guys. See you next week.
Take care.